let's get into the executive summary here. Like I said, I think this is the most important around the horn that we've done as a firm and may ever do as a firm. So grab your popcorn. This week's key macro question is this the beginning of the end of the U.S.'s exorbitant privilege? And that's a huge question. I'm certainly not smart enough to determine the answer ex ante. I certainly won't talk with any degree of certainty here. This is all probabilistic. However, I do think we need to ask and try to answer the question, and we're going to do that for you today as best as we can. So our answers are, in our view, this past week represents the most transformational week in asset markets since the Lehman Brothers bankruptcy catalyzed nearly 2 decades of fiscal and monetary policy largesse. Geopolitically driven stress in the Treasury market is accelerating the transition from U.S. exceptionalism to the U.S. being an emerging market in capital flight risk terms. President Trump may be operating under the assumption that the U.S. is too big to fail, and foreign creditors may check him on that. Markets thought Lehman was too big to fail, too. This transition has several profound implications for asset markets. Number one, the rest of the world has much more negotiating leverage than anyone in the Trump administration is willing to admit publicly, increasing the probability that reciprocal tariff rates are broadly lowered in deals that President Trump will celebrate as wins, but are likely less effective than the phase one China trade deal and USMCA he negotiated during his first term. We wouldn't be here today if the art of the deal actually worked during his first term. Number two, and so obviously all that's bullish. Number one is obviously bullish. Number two, incremental dysfunction in the Treasury market will force the Fed to expand its balance sheet in support of its financial stability mandate. So that's bearish until it gets bullish. Number three, incremental dysfunction in the Treasury market will force regulators to accelerate financial repression as well. We consider any financial repression anything that forces banks into the Treasury market and or forces investors broadly into the Treasury market. For example, removing the supplementary leverage ratio for Treasury securities, which we expect to occur at some point this year. And then number four, the Fed may be forced to hike rates during future recessions to attract capital to the Treasury market. Let me say that again. The Fed may be forced to hike rates during future recessions to attract capital to the Treasury market, like emerging market economy central bankers have to when they're in recession. This is a big deal. I'm not smart enough to know if we're starting this process today, but I do think we need to ask and answer these questions. And like I said, we're going to do that for you today in our fundamental section before we wrap up. So in terms of KISS, no pivots today. KISS is currently at 70% cash, 0% stocks, 30% gold, and 0% Bitcoin. Let's keep moving here. So the following content is intended for use by retail investors and should not be reconciled with our fundamental research views or anything we discuss beyond slide 11 of this presentation. If you guessed our simple and systematic KISS portfolio construction process, you've guessed right. If you know, just for those who may be new, kicking the tires on KISS, let me just give you one quick stat here, or two quick stats rather. If you can't do 20+% average annual returns with a max drawdown of minus 12%, so a Calmar ratio of basically 2, that's max average annual return divided by the max drawdown. This is your hurdle that you need to beat if you're not going to participate in our KISS portfolio construction process as a retail investor. KISS is extremely effective at what it does, as evidenced by the epic run we've been on since we launched it back in January 2023. If you wanted to compare KISS, which again is risk managed exposure to stocks, gold, and Bitcoin, it incorporates volatility targeting and dynamic position sizing to increase and decrease the exposures over time. If you wanted to employ KISS, that is KISS. But if you wanted to just be naked long stocks, gold, Bitcoin, 60, 30, 10 stocks, gold, Bitcoin all the time with no dynamic position sizing, no vol targeting, just 100% exposed to those assets all the time, KISS has a upside capture ratio to that strategy, that naked long strategy of 98%, but a downside capture ratio of only 49%. So you're essentially getting the same return that you would if you were naked long these assets all of the time, but you're cutting out half of the downside risk. You're cutting out half the risk. And so that's exactly what institutional investors get paid to do. We get paid to help investors participate in bull markets while risk managing and chopping off the left tail of the distribution heading into bear markets, just as we've done for you here in 2025, much like we did for you in December of 2021 heading into that bear market. So we have a little experience, actually have a lot of experience. I've never been on the wrong side of a bear market since I started my career in 2009. So that's something I can say. Never got my clients blown up in a bear market, but I'm also not a perma bear either. I also help our clients make money in raging bull markets, just as many of you guys experience experience over the past couple of years as well. So, this is a fantastic service. I'm really proud of what we built here. Really proud of you guys for having the thoughtfulness to join us at our very low rates. And by the way, if you don't like what we're doing, or you don't like me, you don't like anything we say or do, the easiest cancellation policy in the world. You can cancel anytime without penalty. The reason we do that is because we want to align our entire team's motivation, our interests, and our passion with your guy. We want to be incentivized to maintain our clients, as opposed to what a lot of folks do, which is lock you up for a year and pump out a bunch of crappy research that doesn't help you make money in bull markets, or help you minimize downside capture in bear markets. That's not what we do here. We're on the tape every day helping our clients achieve superior results. So let's get back into this because we had a lot to cover. So in terms of KISS, as I mentioned, we're at 70% cash, 30% gold. We're at 0% of our maximum exposure of 60% in stocks, 100% of our maximum exposure of 30% in gold, 0% of our maximum exposure of 10% in Bitcoin. It's a fantastic week to be long 30% gold and no bonds. I mean, a lot of investment advisors and got their clients long a bond market that's blowing up that we've been warning you guys about for years in our since summer of 2023 in the context of our investing during a four-turning regime research. We've identified a geopolitically driven supply demand imbalance in the treasury market that accelerated and had significant market impact this week in terms of forcing the Trump put as it relates to the reciprocal trade tariff negotiations. So, I think we're early innings in this movie. This is not going to end anytime soon. We're in the middle of a four turning, so it's probably going to get better or get worse before it eventually gets better. So just buckle up and be thankful that, we had the foresight to pivot KISS out of the bond market and into gold back last October. That Around the Horn was our October 28th Around the Horn presentation. We've had exposure to gold since then in KISS as opposed to the bond market. And I want to say, bonds are probably flat to down since then, and gold's up about gold's up about 18% since then. So kudos to the fine folks of 42 Macro for making that call, and kudos to you for having the foresight and the thoughtfulness to just participate in a strategy that most retail investors couldn't produce on their own. So KISS makes investing very simple, very easy. It's a pie chart asset allocation. I can't stress enough. Just follow KISS if you're a retail investor, at the bare minimum, until we get to the other side of this bear market. Keep moving here. Oh, one final thing I'll say is please review the KISS FAQ and the Dr. Mo FAQ. If you're going to be using those signals to manage your asset allocation and portfolio construction, it behooves you to take some time and review that. I got a question in the community chat about, okay, I'm a new subscriber. How do should I dollar cost average into this? Should I do that? I'm like, we answered all those questions in the KISS FAQ. So just please make time to review that. We don't want to be wasting too much everyone's time in the community chat on simple stuff like that. So get into the allocation. So we use USFR, floating rate treasuries, to manage our liquidity. Use whatever you want, money market fund exposure. In terms of the stock allocation, so the actual exposure is 0% of the target allocation of 30%. Target allocations cut in half at 30% because we're in a risk-off market regime. The actual exposure is 0% of that because S&P 500 is bearish from the volatility adjusted momentum signal. So that's the top-down and bottom-up risk management overlay coming together to formulate the exposures you see here in this pie chart that you fill in your portfolio. The actual exposure of gold is 100% of the fixed target allocation of 30% because gold is bullish. Bitcoin, the actual exposure is 0% of the target allocation of 5%, which is cut in half because we're in a risk-off market regime, and the actual exposure is 0% of that because Bitcoin remains bearish. So let's keep moving here. The following content is intended for use by professional investors and very sophisticated retail traders. If you insist on making your life harder than KISS is, I dare say if you're not following KISS, you're just choosing to make your investing life harder, and that's totally fine. You're welcome to do whatever you want. We will support you no matter what you want to do with your own money. But everything we say beyond this slide, that's why I'm pausing to say this, is for professional, it's for institutional investors to make capital allocation decisions. If you want to go along for the ride with them, be my guest, but just be aware that they're getting paid a lot of money to do that, and you're not. So just make your job hard, make your life easier, and get back to hanging out with your family or pursuing your passions. So anyway, the following content is intended for use by professional investors and should not be reconciled with KISS. Don't try to reconcile anything I say beyond this slide with KISS. If you're a retail investor and need help understanding any of the following content, please study the educational resources on slide 3 and or just follow KISS. Again, just follow KISS, like Nike. Just do it. Just do it. Anyway, so in terms of how we help our institutional investor clients, stay on the right side of market risk, the number one thing we do for them and you is for everyone, for all of our clients, is to help them identify and position for the market regime. We do that for retail via KISS, and we do that for institutional via Dr. Mo. And everything else we say, including the potential loss of U.S. exorbitant privilege, that's all down here to help us anticipate, help us understand what the full distribution of probable economic outcomes is, so that when the market decides it wants to start pricing in, let's say left tail risk today to potentially pricing in right tail risk, we are understanding why that is happening. And moreover, we can actually anticipate when that might start to happen so that when our market regime, KISS, and Dr. Mo signals change, you go, oh, yeah, that makes sense. Let me do the change in my portfolio, as opposed to why is it bullish now? I don't know. That's why we do fundamental research, is to create a level of calm, dispassionate execution amongst our client base when responding to our KISS and Dr. Mo signals, which are fantastic tools to keep you on the right side of market risk, as we've continued to prove over the past few years. Keep moving here. In terms of our fundamental research summary, so for those who are new, these themes are organized in chronological order of when we introduce them to you. So we'll start with our sticky inflation theme. We introduced that in January of 2022 with the time horizon of 1 year plus from today. U.S. inflation is unlikely to durably return to the Fed's stated 2% and de facto 2.5% targets without an actual recession, an NBER-style recession. Since last summer, our grid model has been forecasting an uptrend in inflation throughout 2025. Although both the Fed and investor consensus have recently capitulated into our view, we still anticipate upside surprises over the medium term. We do not believe the net impact of easy comps, tariffs, and restricting immigration is fully reflected in consensus estimates. In terms of our resilient U.S. economy theme, we introduced that in September of 2022 with the time horizon of 1 year plus from today. The U.S. economy remains resilient due to historically strong private sector balance sheets, dovish monetary policy, labor hoarding. Leading indicators currently signal a low probability of an actual recession over the medium term. Again, when we say actual, we're talking NBER-style recession. Technical just means, consecutive quarters of negative GDP growth. Since last summer, our U.S. grid model has been forecasting a downtrend in growth throughout 2025. Although both the Fed and investor consensus have recently capitulated into our view, we still anticipate downside surprises over the medium term. We do not believe the net impact of tough comps, historically elevated policy uncertainty, tariffs, restricting immigration, and DOGE budget cuts is fully reflected in consensus estimates. It's not. A technical recession is likely as President Trump kitchen sinks the economy, per the view we authored last fall. Jay wants the soft landing thing. We introduced that in November of 2023 with the time horizon through May of 2026 when Jay Powell is done at the Fed. The Fed has a modestly dovish reaction function that is geared towards engineering a soft landing in the U.S. economy. We expect the Fed to end the Treasury portion of balance sheet runoff in the first half of 2025. The Fed is implementing its typical fourth turning playbook, which is to support fiscal dominance by artificially engineering demand for U.S. Treasuries amid above target inflation and explosive growth in federal debt. Fiscal dominance demands substantial monetary debasement and financial repression over the long term. And they need to support fiscal dominance by artificially engineering demand for U.S. Treasuries amid above target inflation and explosive growth in federal debt. Normally, that is cutting interest rates and doing QE in a world where the rest in a regime where the rest of the world is very concerned about the U.S.'s twin deficit dynamics. Then it may actually include hiking rates and doing QE. Right? Think about that. You might have to hike rates to attract capital and do QE to maintain the smooth functioning of the market. I mean, this is, and quite frankly, you heard it here first. At some point in the next 5 years, that may be an outcome. The Fed has to hike rates in recession and do QE while doing QE. It sounds crazy to say today, but again, this is based on our analysis. That's where the bouncing ball is likely headed if we stay on this track, and we very well are likely to, just given the gumption with which the Trump administration is stepping on the gas in terms of accelerating the fourth turning polycrisis that we've been helping you guys prepare for every month in our macro scouting report presentations since the summer of 2023. Although the 72-year-old Jay Powell likely wants his legacy to be the steward of a rare soft landing in the U.S. economy, uncertainty surrounding fiscal, regulatory, and trade policy will likely cause the Fed to be late to supplying the QE asset markets likely require to truncate the global debt refinancing air pocket that we're currently in. Triple S's theme, we introduced that in November 2024 with the time horizon into or through the fourth quarter of 2025. The economy and asset markets may struggle amid uncertainty regarding the size, sequence, scope of potentially dramatic changes to fiscal, regulatory, and trade policy, especially from asymmetric starting points in the growth and positioning cycles. First, the size of President Trump's tax cut proposals may get haircut by deficit hawks in Congress. Moreover, the sequence of policy implementation may cause problems due to the negative supply shocks from tariffs and restricting immigration and the negative demand shock from DOGE occurring before the positive supply shocks from tax cuts and deregulation. Worse, the economic impact of the positive and negative fiscal, regulatory, and trade policy shocks is likely to be negative on a net basis. Per the Q1 QRA and Treasury Secretary Scott Bessent, the scope of Treasury net financing policy is unlikely to evolve in a hawkish manner for at least the next several quarters. That outcome is positive for U.S. liquidity. The debt limit breach is also positive for U.S. liquidity for the following two reasons. Number one, it is perpetuating a significant reduction in the Treasury general account balance. Number two, it reduces net financing to zero, which frees up investor balance sheet capacity to capitalize risk assets. Moreover, the scope of tariff policy, specifically reciprocal tariffs, lowers the risk of a too strong U.S. dollar that reduces global liquidity because the U.S.'s trading partners may opt to negotiate lower trade barriers than offset fresh tariffs via currency devaluation. Lastly, the potential beginning of the end of the U.S.'s exorbitant privilege may catalyze a monetary inflation if the Fed is forced to backstop the Treasury market, and they may very well will be forced if we continue to see the kind of dysfunction that we saw, this week. Shifting gears to our quantitative risk management. Oh, and by the way, anytime you see yellow highlighting in our fundamental research summary or quantitative risk management summary, that just means there's a material change from the preceding 42 macro research report. So shifting gears to our quant summary here. In terms of our short-term signals, these tend to get resolved in a 1 month or less time horizon. Our crowding model is currently generating bearish signals in the euro and Swiss franc. Our probable range model indicates commodity producers and agricultural commodities are overbought. The U.S. dollar index is nearly oversold. The two-year nominal treasury, the two-year U.S. nominal treasury yield is nearly overbought. So in a week where we saw significant downside surprises in inflation and collapsing consumer confidence, we had the dollar go down and two-year yields go up. Like this is the market essentially pricing out rate cuts in a week where we very clearly got information that suggests we should be pricing in more rate cuts. That's, in my opinion, that's a telltale sign of something. We'll keep it moving here. Short to medium term signals, these tend to get resolved in a 1 to 3 month time horizon. Our dispersion model indicates rotational flows have been generally balanced on a trending basis. Our positioning model indicates short to medium term positioning indicators indicate retail traders are underweight stocks and active managers are underweight stocks. Speculators are neutral stocks, underweight treasuries, neutral to the U.S. dollar, and underweight commodities. Our positioning model indicates moderate risk of a rally in risk assets over the short to medium term. In terms of our volatility adjusted momentum signal among the four horsemen of market risk, the high beta, low beta ratio is bearish. The cyclicals defensive ratio is bearish. The value to growth ratio is bullish, and the small cap, mega cap ratio is bearish. Risk assets are mixed. Stocks are bearish. Crypto is bearish. Commodities are mixed. Defensive assets are mixed. Treasury bonds are bearish. The U.S. dollar index is neutral. The CVIX, currency vol, move index, bond vol, VIX, equity vol, and gold are all bullish. And then lastly, our medium to long-term signals, these tend to get resolved in a 3 to 12 plus month time horizon. Our global macro risk matrix indicates deflation is the current market regime. Deflation is a risk-off regime in which investors are generally rewarded for reducing risk because policymakers are unlikely to adequately support real economic growth that is perceived to be decelerating or persistently lower than expectations. The key portfolio construction considerations in deflation are defensive assets tend to outperform risk assets. Low beta tends to outperform high beta from a factor standpoint. Defensive tends to outperform cyclicals from a sector standpoint. Growth tends to outperform value. Large caps tend to outperform small and mid caps. The U.S. tends to outperform international. Developed markets tend to outperform emerging markets. Treasuries tend to outperform spread products in the fixed income market. Long rates tend to outperform the belly, which tend to outperform short rates in the treasury curve. Investment grade tends to outperform high yield in the credit market. Ag commodities tend to outperform energy commodities, which tend to outperform industrial commodities. And then finally, gold tends to outperform the U.S. dollar, which tends to outperform foreign currency. So most of that stuff is happening, but the stuff with respect to U.S. international, dollar outperforming foreign currencies, there's some real shifts here in terms of, very clearly being in a deflation market regime on a trend basis. But the dollar's very much behaving like an emerging market currency, and as is our bond market. In terms of the global liquidity monitor, global liquidity is currently trending lower. Key leading indicators of global liquidity currently signal a modest uptrend over the medium term. In terms of our grid model, inflation, which is growth trending lower and inflation trending higher, is the modal outcome from a bottom-up macro regime perspective in the U.S. economy over the next 3 to 6 months and next 6 to 12 months. In terms of our macro weather model, that's currently generating a bullish 3-month outlook for stocks, bonds, commodity, and Bitcoin, and a bearish 2-month outlook for the U.S. dollar. The composite signals currently indicate a high probability of sustaining a risk-on market regime over the next 3 months. And so if the macro weather model is right, what is essentially signaling potentially the macro weather model could be a leading indicator of the Fed being forced to backstop the treasury market and ushering in another monetary inflation as a function of its third mandate, the financial stability mandate. We saw this obviously they stepped in during COVID to backstop the treasury market and the broader credit markets. We saw them pivot back in the summer of 2023 they pivoted from with inflation being well above target to they pivoted without the policy rate even going restrictive from the perspective of the Taylor rule. Never in history has the Fed defeated inflation without the policy rate going restrictive, according to the Taylor rule, and they pivoted irrespective of that. So, in my opinion, that's a potential sign. That was another indication of that. We saw that in the regional banking crisis as well. When the banks started to blow up because of the treasury market, their exposure to the treasury market, the Fed had to backstop that as well with the BTFP and other programs. And so we keep getting these episodic, bond market blowups and Fed having to backstop that, and the frequency of that is starting to get alarming. I think you have to be a little bit alarmed as a U.S. citizen and just an investor generally, because that represents a significant regime change that none of us really knows how it's going to play out. And so I think the need for having systematic risk management overlays is greater than ever, because I don't think a human being, I certainly can't. I'm the one creating all the research, and I'm telling you, I don't think I can trade this just using fundamental research alone. Thank God for KISS and Dr. Mo, in my opinion. And then finally, positioning model indicates medium to long-term positioning indicators indicate investment advisors are neutral stocks, neutral bonds, and underweight cash. Systematic funds are underweight stocks. Market neutral hedge funds are neutral risk assets from a gross exposure perspective. Risk asset valuations are no longer consistent with major bull market peaks. Our positioning model indicates low risk of a crash in risk assets over the medium to long term from here. Recall that it signaled high risk of a crash in risk assets over the medium to long term at the all-time high in the SPY back on February 19th. So obviously we got the crash. So hopefully that was a helpful, I know I've been talking for a while. For those who are busy professionals or just busy in general, you can sort of hop off if you ever wanted to in these around the horn presentations after the quantitative risk management summary. Everything we talk about after the quantitative risk management summary is just me unpacking the important elements, what's changing at the margins from the perspective of our fundamental research and our quantitative risk management, and obviously unpacking the question that we ask and try to answer in the executive summary as well. So this is if you want to get the Cliff Notes version of the around the horn presentations, now would be a good time to hop off. But I highly recommend you stick around for us to ask and answer the question that we posed in the executive summary, i.e., is this the beginning of the end of the U.S.'s exorbitant privilege? Because again, the implications of that are profound, and if you're not asking these types of big questions in a fourth turning, you're not paying attention. And if you're managing other people's money and you don't want to stick around and listen to this presentation, I dare say you're not being a fiduciary. So let's keep moving. And one final thing I'll say. Traders, again, I'm talking to professional investors and very highly sophisticated retail traders. If you're a regular retail investor, cover your earmuffs, think KISS and earmuffs. We hope you're paying attention to the short-term signals we feature in our quantitative risk management summary. So this is what our quantitative risk management summary signaled on Friday, April 4th, in terms of the short-term signals. It was currently generating bullish signals in energy and levered loans. It said the S&P was oversold, Russell was oversold, commodities were broadly oversold, VIX was overbought. And then on Tuesday, when we came back from our one-day vacation, on Tuesday, it signaled the crowding model was generating bullish signals in mega cap growth, consumer discretionary, commodities, Chinese equities, emerging market bonds. And then it was signaled the probable range model said gold was oversold. So, we don't refresh these models for poops and giggles. The models have impact. And so if you're paying attention, you can, if you want to trade this, which I again, retail investors, do not trade this. Just pay attention to KISS, take a longer term perspective. Don't get whipped around by 10% up days, fastest up day we've seen since October 2008. What happened after that? Don't get whipped around by these big up days and big down days. Just relax and invest calmly and dispassionately because of KISS. For those who don't have that luxury because they're getting paid a lot of money to manage other people's money, they need to make those shorter term tactical decisions in their portfolios or client portfolios. And so I just want to make sure we're paying it. I'm not just glossing. I'm not reading fast because I want to gloss over it. I'm reading fast because there's a lot of content to cover, and I want to make sure we get people out in a reasonable hour. So just be aware of these. These signals obviously nailed what happened last week. So just be aware of that.